the average sales price for the entire Houston area, right? That includes Katy, that includes Cypress, that includes
Mhm.
Houston, all the suburbs, everything. It's about 345, right? And that's, with 345, depending on what area you buy in, you could get a very, very, very decent house, like a really good size, that with great amenities and security and safety. But most of the last few transactions that we've done have been under 280, which you're still getting a really, really comfortable house. So worst case scenario, let's say you're hitting the average. So about 5% of 345 is $17,000, right? Plus, uh, what is on 345 your monthly payment, and maybe we can talk a little bit more about what monthly payment looks like. Your monthly payment, do you know what that would look like? Assuming maybe like an average tax of 3%.
Maybe around maybe 29, 28, about 28 to 2,900.
Okay, so call it 3,000 a month. At worst case scenario, right? And that's with a pretty high tax of 3%, 3.2%.
Mm-hmm.
Um, and that's right now with whatever the interest rate is today.
Yeah, about 6.5. About that.
Yeah.
Pretty common these days.
And that's 345. And we mentioned that just because, like Isaac mentioned, having those reserves, right? So having another nine or $10,000 in the bank. So maybe overall you can jump into the market with 27, $30,000, which I think is a pretty safe number for any unexpecteds, right? So
Mm-hmm.
whenever we go out and buy a home, or we're looking for homes with clients, here's the number one expectation whenever we're shopping, right? Um, you're not you're not going to find the perfect home. And I think you alluded to this in the beginning. Typically, that first home is not the forever home. It's usually not. I have clients that literally bought a new construction home last year, and next year we already know we're going to sell it because I'm already seeing where the market's headed in their area, and they're going to upgrade from a one-story, three-bedroom, two-bath, and likely we'll see what the market does, move into a four-bedroom, two-story. That's going to cost somewhere around 300,000 because we negotiated them a good deal with the builder. They got great, bless you. They got great terms. They're able to save, and they're putting a lot towards their equity. So they're going to either be able to rent it out or sell it and come out really well. So house number one is usually not the forever home. First of all, secondly, you're not going to find all your must-haves in that first home, and that shouldn't discourage you because, like I tell people all the time, it's the biggest winners in real estate. It's not the realtor, it's not the lender, it's not even the people that the lender is whose money they're lending. It's the banks. It's the people that are. It's not even the banks. It's whoever's giving out the money for everyone to lend, to use, to borrow, to circulate through the economy, because that money's coming back plus an extra 2%, 3% interest, right? Because even when you're lending money, you still have to pay a certain amount to lend it out. So you're usually just making the difference in those interest rates. So the ultimate winner is not you or me or the consumer. It's the bank. So I would say always play the game rather than just throwing the money away on rent. And the first thing to know is exactly how much house you can qualify for, because even if, and we can get into monthly payment, 100% of that payment is not going to come back to you as equity, right? So we have principal, we have interest, we have taxes, we have insurance, and it's homeowners insurance. We have mortgage insurance, uh, and we can talk a little bit about maybe on that same, like maybe a $345,000 purchase, $3,000 a month. What would go towards the principal? How much am I actually paying down into the home? Is that something you'd have an idea of?
I can.
Yeah.
So roughly, I mean, just paying an interest
Hmm.
on a 345 home is roughly about 1851 a month, just on interest. So in principle, it's going to be very little. Like the first couple of years of owning, it's mostly interest.
Hmm.
So it'll be interest of 1851 a month and principal of about $300,
Right.
and that will give you a combined monthly payment of roughly of principal and interest of $2,200,
Hmm.
just principal and interest, not including taxes.
Yeah.
Um,
Yeah, and then so then let's say for example that same $345,000 home, which is something that people are not super privy to, is the county, at least for us, the county is assessing the value of the home for tax purposes, and they're doing this every single year. So they're going to take the tax rate for your community or the section of your community, and
Hmm.
you gotta it gets really specific. The tax rate is represented as a percentage, right? So it's going to be a percentage of the assessed value that the county gives us. Usually, it's less than the purchase price. It has, and that's a distinction I want to make. It's going to be different from the purchase price, which is it's super important to know, how much you're qualified for, because you got to take all these little payments into the equation. But anyways, let's say on a $345,000 home, you could potentially be paying 320, $315,000 in taxes. It just in assessed value. So for simple numbers, at 3%, that's $9,000 a year, which $9,000 a year divided by 12 is $750. So you're paying $750 additional on top of that $2,200 that you're describing, plus another $100 in uh, homeowners insurance. And I don't know if you have mortgage insurance, how much more are we talking about?
Maybe like an extra 175.
An extra 175. So
Yeah.
175 plus 2,200 plus 750. You're talking about 3,125 on a $345,000 purchase for the first couple of years. A lot of that money is not going to go towards paying down uh, the total amount. So that's why it's so important not just to know how much you can afford, but what your plan for the property is. If you don't know how long you're going to be in the property, and regardless of what the market is doing, right? Because these are things that are always shifting. If you're getting into the market, if you're jumping into it and you're not planning on being there more than a year or two, you're likely going to lose money unless you get lucky and it's an up market whenever you're going to sell, right? But it's you have to know how much you can qualify for, and we have Isaac here who works with a specific lender, but most of these guidelines are pretty even throughout the lending community, unless they're offering, maybe tell me if I'm wrong, but unless they're offering something outside of what your conventional products are, uh, pretty much all guidelines are the same. Am I wrong?
Most of your value, like most of like the low down payments, lower interest rates would be in loans that follow Fannie Mae and Freddie Mac guidelines, and those are nationwide.
Hmm.
There's some if there's a problem where you've been working less than 2 years, or maybe you're self-employed, we can still get you in a home, but not with these traditional guidelines. It's outside of those guidelines.
Hmm.
And that will require typically more down payment, a little higher interest rate, but everything's possible. We just need the consistency. If you're self-employed, if you're looking at this, you're self-employed. If you've been consistently increasing for at least a year, we can get you inside a home. It may require some other additional steps, like a stronger down payment, a little higher interest rate, but it's possible. But where you see the most of the value is following your Fannie Mae and Freddie Mac guidelines.
So the Fannie Mae and Freddie Mac guidelines are an interesting one, and maybe we should tell people a little bit more about them. I'm not going to ask you to recite them, but maybe telling people that Fannie Mae and Freddie Mac are essentially they're not really government entities; they're more like private institutions that are setting these guidelines because they are going to. Why do we follow their guidelines?
We follow the guidelines because it's what that's a good question, really. We follow the guidelines because if people who have been people who have been homeowners, if you notice that your loan has been sold a couple times, transferred is to be sold. So we follow these guidelines because they're a little more stricter than what they used to be. Because of 2008,
Hmm.
we were giving out a lot of bad loans at the time. People were not people who should not been qualified were getting qualified.
Right.
So because of that, we now have guidelines what to follow, which is government, which is FHA, VA, conventional, USDA. All of those have guidelines we have to follow, because if we meet the guidelines, then we meet the selling guidelines to be sold and transferred to other banks.
So essentially, what Fannie Mae and Freddie Mac does is we'll set the guidelines, and we'll help. This will help us then transfer or sell that loan to another bank or to another institution. because
Plus,
it
yes.
go ahead.
Plus they see you as a well qualified candidate. Like you're solid. Um, and that can be as little as 580 credit score, a little money in the bank. I mean, some guidelines are really there to help home buyers. But you're essentially, if you get approved with traditional financing, you're well qualified.